The world of bank strategy has been shifting pretty significantly over the last 4 or 5 years. So 5 years ago, financial institutions would make strategic decisions around whether it be new products or geographies, even counterparties in some cases, without considering things that I would say would be commonplace today, particularly around risk, capital, and regulation. In terms of the banks, on the consumer side, first of all, you're seeing a big trend away from globalization, more towards regionalization and nationalization. And if you look at some of the major players in the world, there are very few global banks that are left. If you think about market structure, there are some major trends that are very, very important. So trend number one is, again, driven by regulation. The entire derivatives market is being shifted, or a significant chunk of the derivatives market is being shifted from what we call over-the-counter or bilateral types of arrangements that are highly customized to more standardized, centrally cleared, more standard trades, if you will, and instrument types. So clearly the banks are faced with, across the board, revenue squeeze in terms of whether it be product simplification or higher capital charges or other reasons. And therefore, you've got to offset that and create an acceptable return on equity. The biggest thing the banks can control is the cost. Well, the biggest challenge today that is reported to us by the CEOs, and certainly backed up by our experience in working with them, is around the creation of an optimal portfolio of businesses given the amount of capital and liquidity that the financial institution possesses. So the equation is to create and to allocate and optimize the use of capital, whether it be across different product sets, geographies, and the like. And the ability to do that and to make good, sound decisions in terms of where you put your capital is, if you will, the differentiating factor in many cases between those firms that are at the top of the charts and those that are not. Well, the Eurozone presents a series of challenges for financial institutions, and not just European financial institutions, but financial institutions around the world. We recently published a report on the state of Eurozone and global financial institutions and their preparedness for an exit scenario within the Eurozone. So what we found were really, I would say, 3 levels of preparedness, right? We found that operationally, people were generally, the closer they were to the Eurozone, the better prepared they were. Further away, the less prepared they were. From a financial investment perspective, we found that there's generally, people had taken the kinds of measures they could to limit their exposure, both from a direct kind of ownership of sovereign debt as well as a counterparty risk. So I think we've also, I'd say on the third side of this, we've seen firms that are just starting to, if you will, understand the full depth of some of the shocks and what they might mean to them. So what do I mean by that? Is that the euro is so big and so important that even if you're not directly operating in the Eurozone, you will have an impact on your business if there is a problem with the single currency. It's just so large and so important as a global trading currency, and the people you're dealing with from a counterparty and risk perspective will have exposures there. The euro is such a large and important currency that a disruption in the Eurozone, if it results in an exit scenario and significant economic crisis, it will be almost impossible for anyone to escape the impacts of that. As within any crisis, those that have the liquidity and are able to take the risks are able to profit from those that have to sell or reduce their exposures. there are some very attractive opportunities in terms of assets and asset sales. In fact, many of those assets are not even in the Eurozone, because many of those institutions will look to sell the assets that they can sell, and many of those assets sit in places like the United States or in places like Asia. So there's some great opportunities that way. I think the second thing that's important here as well is that the Eurozone offers, the Eurozone economies are actually starting to restructure. They are actually introducing labor reform, fiscal reform, and the like. And I think the key question will be, once that consolidation, that fiscal consolidation, starts to take hold, and there's a level of confidence that will hopefully grow in the region, there will be opportunities for people to move back in, because there will be an eventual rebound here. It's just a question of when it's going to happen. Right now, the banks are very eager to keep their current investors, and what they want to do is to be able to attract additional investors down the road, hence the focus on return on equity. So the chief financial officer is usually the primary spokesperson with the investor community, and the chief financial officer needs to be able to explain and articulate in very concise way the strategic decisions and imperatives of the organization and the impact on things like return on equity, the impact on tail risk, and things like that. The importance of technology has never been greater. So no one disputes how important technology is to accomplishing the business agenda. And when you look today at things like the need for management to have information at its fingertips, to be able to aggregate information, to be able to introduce new products to clients, to integrate social media into the strategy and what the business is doing, absolutely critical. 2013 is a year of a couple of things. One, in the capital markets side of the business, so the investment banking capital markets side of the business, it's the year where we start to see the fruits or the result of some of the regulation and capital rules that are either in place or coming in place. And what that's meaning is, frankly, fewer global players in the capital markets, a shrinkage, and a focus in terms of regional and local capabilities, and some of the regional and local banks growing their capital markets capabilities. So that's a very interesting movement in the capital market side, but the large investment banks are largely shrinking to a smaller number of global players. For this year is the year where banks start to focus on return on equity and bringing the return on equity numbers up towards their cost of capital, and start moving on the long-term 2 to 3 year plan, if you will, to get their return on equity in a way that's going to allow them to retain and attract investment and capital in the private markets as opposed to through governments.